Hi guys! In today's video we're going to have a look at the second final account out of the two that we're going to learn about, and it's balance sheet. So how is balance sheet different from the profit and loss account that we saw last time that we saw each other? For the profit and loss account, it shows us how much profit we made in a period of time, in 1 year. However, the balance sheet shows us the situation that the business is in on a particular day. Sometimes that's why it's referred to as a snapshot of the organization's financial situation. Snapshot because it's almost like taking a picture. It doesn't show you any changes throughout a period of time, it just shows you the situation at the given moment. So, balance sheet is probably best described on a specific case study. So, here, the short case study, I'm going to read it and then we're going to explain certain aspects of the balance sheet. Sanchez plans to start his own business. A government business advisor asked him, "How much money can you put into the business?" And Sanchez had to admit he did not really know. The advisor asked him for an approximate value of everything he owned, including any bank accounts, as well as any debts or loans that he had. Together, they made these two lists. On the left, we can see all items owned by Sanchez. So there is a house, car, savings, a bank account. And when you add that up, the sum of all the items that he owns is $58,000. Then on the right side, Sanchez wrote down all the debts that he basically owed to somebody. So he still has a loan on the house, a mortgage, worth $18,000. He took a bank loan on the car worth $3,000. He also owes his brother $1,500. And therefore, the total sum of the things that he owes to someone and needs to pay back is $22,500. The advisor told Sanchez, "The total value of what you own is therefore $35,500, more than the value of what you owe." So the difference is called equity and means that basically, theoretically, you could invest this much of your own capital into your new business. Unfortunately, however, the things that he owns are not all in a cash form, so he cannot just take it and invest it into the business. But this case study nicely shows us the three things that a balance sheet of a business, of a company, also shows us. Yeah. So on one hand, the balance sheet is going to show us the assets of the business. So assets, as we talked about last lesson or the lesson before, are all the things owned by a certain business. And then it also shows us the liabilities. So as you know from the sources of finance, liabilities are all the debts, either short-term or long-term, all the debts of a business. So things that we still need to pay back, depending on the length. I mean, whether it's a short-term loan or a long-term loan, it gives us the period of time in which we have to pay it back, but we still need to pay it back. Usually for the liabilities, we pay some interest. So that is the second thing that the balance sheet shows us, the liabilities. And the third thing is called equity. Equity basically means the wealth of the business. So it shows us how much value the business has. So in this case, Mr. Sanchez's equity is $35,500. That's what he is basically worth in terms of money. If we take him as a business, if we perceive him as a business, He is worth that much. That is his equity. And the same thing we can do with a business. An exam tip. The house is an asset which belongs to Sanchez, but this does not mean that it has been paid for. A building, an asset, could be worth a lot, but is funded mainly by debt, with the remaining amount being the equity. So if, an exam is going to be asking you some question regarding the balance sheet, don't be tricked by looking at the value of the assets and thinking, wow, this company is like really wealthy, they're doing really well. You also need to be looking at how all these assets have been paid for. So the balance sheet tells us how much the business is worth. It lists and gives the value to all of the assets and liabilities of the business. So assets are any items of value. These can be long-term or short-term. Long-term assets would be buildings, property, equipment. Short-term assets would be, for example, inventories or stock. Then liabilities are debts owed by the business. They can be long-term liabilities or short-term liabilities. So that we have the definitions. And we always start with the assets in the balance sheet. So the balance sheet is going to list all of these from the top to the bottom. There are also different ways of how to portray the balance sheet. For example, by putting the assets on the left and the liabilities and equity on the right. However, the IB standard wants you to list it like vertically, all below each other. So we start with assets. And the first thing that we start with are fixed assets. Fixed assets mean that they're long-term. Okay, it's just another word to say long-term assets. We can also say non-current assets. You'll get used to the terminology. And the second thing that you list are all the current assets. So like I said, inventory, stock, it can be even cash in cash form, cash in hand, or cash on the bank account. So always we start with the most long-term assets at the top. So property is the hardest to sell. Then vehicles, equipment. We also mustn't forget intangible assets. We're going to discuss what these are next lesson. Once we list it, we need to create some kind of total. So we will have total fixed assets. Then we deduct some depreciation because all these assets in the long term, they depreciate in value. Once we deduct the depreciation, we have the net fixed assets. And then we have the current assets. We always start with the current assets, which are the hardest to turn into cash. So stocks and inventories, to turn that into cash, you actually need to find still a customer who would be interested in buying your stock. Then debtors, that already means that you have found the customer, he has bought the product, he just hasn't paid you yet. For example, you gave him a credit, and that's why he has some time to pay you back, but that is actually going to be easier to turn into cash form. And the third one that we list is cash. Then we have the total current assets as the sum of all the current assets listed here. And the last sum is the total assets. The reason why I put it in bold is to show that it's a sum of two sums. It's the sum of net fixed assets plus total current assets. The second part that the balance sheet shows us are liabilities. So liabilities, we actually list the other way around to assets. The assets, we started with fixed assets, the long-term assets first, and then we listed the current ones. But here we actually start with current liabilities first, and only then we list the long-term ones. Current liabilities are going to be those short-term sources of finance, such as overdraft, short-term loan, a loan, like for example, trade credit. Those are going to be current liabilities. Then long-term liabilities can be, for example, long-term loans. mortgages, debentures, those kinds of liabilities. And we also list them this way. We start with current ones. So as I mentioned, the different types of liabilities. Then we have a total. Then here I left these blank because there's going to be actually something else, not liabilities. But don't worry, we're going to come back to it in the next slides. And then we list the long-term liabilities. So as I said, long-term bank loan, debentures, and then we have a sum again. The total liabilities, therefore, is going to be the sum of total current liabilities plus total long-term liabilities. Makes sense, right? Because you're just adding up all the types of liabilities. And the last thing here is actually not going to be a sum. It's going to be a difference. It's called net assets. Net assets is going to be calculated as total assets minus total liabilities. And what does it tell you? So think of Sanchez, the case study example that I showed at the beginning. He had a house, but he as well also had a mortgage. So now we need to see like how much of the assets does he actually own already. Yeah. So that is why we need to calculate the net sum, the net value. We are deducting the liabilities from the value of the total value of the assets, and that gives us the sort of the net value that we own. That is going to be our net assets. This is super important because this is one of the ways how to check it with another part of the balance sheet and check whether there is balance in the balance sheet, because that's where the name comes from. The balance sheet is a financial document which shows us what we own and what we owe, and all of these different numbers need to equal, or certain numbers need to equal each other. They need to be in balance. So as we sort of have seen already, the balance sheet contains some useful information on some sums, some differences, and this useful information can be sometimes measured or used to measure the performance of the business. One of the sums or differences that it shows is the working capital. Okay, working capital we have already talked about in one of the previous chapters. It's current assets minus current liabilities. Remember, we defined it as the capital used in a business from day to day. Yeah, it's the capital that we're operating with on a daily basis to basically make our business work. And it shows, and if we have a large sum of working capital, it is actually means that we are maybe not as efficient. In order to increase efficiency, it's suggested to keep the working capital lower rather than higher. And there are obviously certain ratios, like what is the ideal ratio of working capital, for example, stock to working capital and so on. But that is most likely already higher level. We don't need to get into it. And also we're going to discuss working capital as such in the cash flow unit. But right now, for you, the important thing that you need to know is how to calculate it and what is the definition. So before, we already talked about the definition, but now please add to your notes the formula, how to calculate working capital. The second thing that the balance sheet shows us is capital employed. Think about the meaning of that term. Capital employed. Basically, how much capital I am employing, I'm using in my business. And it is calculated as total assets minus current liabilities. So total assets, everything that I own, minus the short-term debts. or it can be calculated as long-term liabilities, non-current liabilities, plus shareholders' equity. It shows us how much capital is working for us to create, to basically finance the business in the long term. You might be confused, why do we also include, why don't we just include the shareholders' equity? Why do we also include non-current liabilities? The reason is because we are using somebody's source of finance in the long term, we're not going to pay it back in a year. Well, not in a year, but for example, in 2 years, 5 years, 10 years, we are actually using their capital for our own interest, for our own benefit, and we can do much more with the business if we have more capital employed in the business. So these net or total sums are listed actually between the current liabilities and the long-term liabilities. So working capital we list right under total current liabilities. And sometimes the working capital is referred to as net current assets. Yeah, get used to the word net. It's going to be there a lot. And the second one, the total assets less or minus current liabilities, is the capital employed, and it is listed under the working capital. Yes, just before we start talking about long-term liabilities. The last part of the balance sheet gives us the information on how much wealth or equity is invested in the business by the owners. Okay, so obviously there is going to be some share capital, which is the capital that you come with at the beginning. In Czech language, we call it základní kapitál. And obviously, you know, at the beginning, it can be just 1,000 crowns, 10,000 crowns, 100,000 crowns. So not much. But the idea is that as you do your business, as you are active, you are increasing the equity of the business, the wealth of the business. How do you do that? Well, I mean, first of all, you need to start earning profit. If you are not going to have any profit, then obviously you're not going to increase the value of your business in the long term. Remember, the number one goal of any business organization is to earn profit. So this is actually how equity increases. It's the retained earnings of the company accumulated over time is also part of equity. So basically the retained earnings is all the retained profit that every year we reinvest back into the company. And by reinvesting it back into the company, we're not giving it out or paying out to shareholders as dividends. We are increasing the wealth of the business. So shareholders' equity is going to be listed this way: share capital, then the retained earnings. Sometimes it can also be called retained profit or profit and loss account reserves. And that adds up to show us the total shareholders' equity. Now, if we insert some numbers into the balance sheet, then it should make sense. It should show us on the left side. I on purpose, I put it into two columns to show you where we create some sum or some difference. So if we insert some numbers, it should make more sense. So have a look at it, maybe make some notes, and let's see where we can get the balance. Where do we arrive at the balance? So there are two ways. First one is to show the shareholders' equity. We know that shareholders' equity is on the bottom. It's the blue one. Shows us how much, like how worthy, how much wealth do we have how much is our business worth, because there's share capital and also retained profit. But that should equal our net assets. That should equal our total assets minus total liabilities, right? Think of the example with the house and the mortgages. And now the second part, or second way how to achieve balance, is to check the balance using capital employed. So we know that capital employed is going to be total assets minus current liabilities, which is here. That is why we need the sum right here. I mean the net sum here. And the last one, or the second part, is shareholders' equity plus long-term liabilities. That is also another way how to calculate a capital employed. And as you see, that is going to be equal. Here we have 174 as the, long-term liabilities are 125. Shareholders' equity is 310. That together makes 435. And that equals the capital employed that we have listed here under the orange value. So in order to practice so this is pretty much everything I wanted to tell you. I wanted to show you about balance sheet at this point. We're definitely going to practice some more using specific activities for you to check your understanding, whether you can tell the difference between current liabilities, long-term liabilities, between current assets and long-term assets. And then slowly we're going to try to create maybe small, simpler balance sheets than what you see here. But eventually you should be able to remember what is the order in which we list these different parts of the balance sheet. And you should also be able to find the balance, to check that you have all the calculations correct. So this is pretty much everything for this video. Thank you very much for watching, for making notes, and see you next time. Bye!